Cisco Systems is trading close to its 52-week close at $47 per share, down 6.4% year to date and over 25% since its recent highs of December 2021. So is this a good buying opportunity for Cisco, or will the stock continue to fall in 2024? In this video, we will answer this question by analyzing the Cisco stock using fast graphs, the fundamentals analysis software. We'll also determine the stock's intrinsic value using 4 distinct valuation methods and decide on an acceptable buy price with a reasonable margin of safety. Ultimately, finding out whether Cisco is looking like an undervalued buy at these levels. Starting with fast graphs, the orange and the blue lines that you see here represent the growth in Cisco's adjusted operating earnings since 2003. Earnings have been steadily growing year to year with an average growth rate of 10% per year. At the bottom here, you can also see the year-to-year growth. Coming out of the dot-com bubble, Cisco had pretty high growth rates, at 52% in 2004 and 21% in 2005. However, more recently, earnings have been growing at a much slower pace, and based on analyst estimates, earnings look to be decreasing this year, going negative in 2024, which could be why the stock is currently underperforming. Now back to our chart. You can think of the orange and blue lines as valuation references. The orange line is based on the Graham dot valuation method, and in this instance, it reflects a 15 price to earnings ratio, while the blue line represents the normal PE ratio that the stock traded at historically, which in this case is 15.9. This basically means that since 2003, investors were willing to pay $15.9 for every additional dollar of Cisco's operating earnings. Generally speaking, the higher the growth rate of the company, the higher investors would be willing to pay to buy the stock, resulting in a higher PE. The white line on the chart represents Cisco's dividend paid per share, which is also steadily growing since the company started paying a dividend in 2011. Currently, Cisco is trading at a 12.7 blended PE, which is lower than both fair value reference lines, which means that the stock could potentially be undervalued. And in case you don't know, the blended PE is just a weighted average of the current price to earnings ratio and future estimates. So with a 12.7 PE, the earnings per share yield is 7.9%, which if added to the current dividend yield of 3.4%, that gives us a total yield of 11.3%, which is actually quite attractive, especially compared to the S&P's current earnings yield of 4.1%. Now, if we add the price line to the chart, you'll see how the stock price generally moves with earnings. The stock price moves up in periods of growth and drops in periods of decline. You can also see that coming out of the dot-com bubble and until the 2008 financial crisis, the stock was trading at a relatively high valuation, reaching a 47 price to earnings ratio in January 2004. And since the financial crisis, there was a very long period of undervaluation, while earnings continued to grow. If you bought Cisco at these expensive levels and held it until today, and I won't even take the top here, let's say you bought it at this point here and held it until today, your total return, including dividends, would be 4%. That's very underwhelming performance and significantly underperforming the S&P 500 over this period of time. Now, let's compare that with buying it at an undervalued price. So anything under those reference lines that we have here, let's say you bought it here at a 13.1 PE, which is still higher than the current PE of 12.7%, so a little bit more expensive than it is today, but relatively undervalued. So let's say you bought it here and held it until today. Your total annual return, including dividends, would be 8.4%. Definitely much better than 4% that we saw earlier. So basically the lesson here is that no matter how great the company is, valuation matters, and it matters greatly. It is very important to consider the valuation you're buying at. The higher price you pay, the lower your future returns. Now, if we look at Cisco's performance since 2003, we can see that it underperformed the S&P 500 with an annualized return of 4.4%, versus 8.1% for the S&P without the dividends. But even with the dividends, Cisco still underperformed, returning 5.8% versus 8.8% for the S&P. However, this is coming from a time of significant overvaluation out of the dot-com bubble as we saw earlier. If I decrease the time frame to the last 12 years, which is also when Cisco started paying a dividend, the performance is much closer to the S&P's, growing at an annualized rate of 11.7% versus 13.2% for the S&P. And considering the stock's recent drop and that it is currently undervalued relative to historical ratios, this is a pretty good return in my opinion for Cisco. Now, before moving on to our valuation models, let's quickly check what analysts are forecasting for the stock in the next few years. And as you know, I generally prefer to use the normal multiple PE ratio, so let's select that one. As we can see at the bottom here, analysts are expecting earnings to decline in 2024 and 2025, before jumping back 8.2% in 2026. We can also see that these estimates are based on a good number of analysts, over 18 analysts for each year. It's always better to have a larger number just to mitigate the impact of any outliers that could exist. Anyways, if we assume that based on these estimates, Cisco just returns to trade at its 5-year normal PE of 15.4 in 2026, this would imply a price of $58.7 per share and a nice annual return of 14.1%. And that's just by earnings expanding back to its historical mean, meaning that the stock wouldn't be overvalued. It would basically be fairly valued at this point. Moving on to our valuation models, there are 4 distinct valuation methods that I usually use. These are the discounted free cash flow model, the multiples valuation model, the dividend discount model, and the historical multiples valuation model. If you would like a copy of these valuation models to value any of your preferred stocks, you can now get one from the link in the description below, which will include all 4 models. And if you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified when similar videos are released in the future. Our first valuation model is a discounted free cash flow model, where we estimate Cisco's intrinsic value based on the present value of their estimated future cash flows. You can see here the free cash flow that Cisco generated over the last 10 years, growing at an average 5.2% per year. Based on analyst estimates, we use a 1% growth rate for future free cash flows. Using an 8% discount rate, we get the present value of all future free cash flow, as well as our terminal value. Adding them together, plus cash and cash equivalents, minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $74 per share, which is higher than Cisco's current stock price, indicating possible undervaluation. Now, if you're more optimistic about Cisco's future growth, especially with the recent acquisition of Splunk, you might want to adjust the future growth rate. You can also change the discount rate to match your desired rate of return. The second method is the multiples valuation model, where we obtain Cisco's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Cisco's earnings per share to get a fair value of $109 per share. Now, in my opinion, this estimate is a bit over the top, especially because some of Cisco's competitors are currently trading at much higher valuations that Cisco hasn't really seen in a very long time. So, to ensure that we don't inflate our intrinsic value estimate, I will just exclude this model from our final valuation. The third method is the dividend discount model, where we estimate Cisco's fair value based on the present value of future dividend payments. You can see here Cisco's total dividend paid per share in the last 5 years, which grew on average 3.9% per year. For future dividends, I just went with the same rate of growth of 4%, basically just growing with inflation. Discounted at 8%, we get a fair value of $40 per share, which is lower than the current stock price, indicating possible overvaluation. The last method that we will review today is the historical multiples valuation model, where we estimate Cisco's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PEs. One thing to mention is that these PE values reflect the GAAP diluted earnings rather than the adjusted operating earnings which we saw earlier. And as we can see here, the Cisco stock was trading at an average 18.6 PE during the last 5 years, 17.9 in the last 10 years, and 18.5 in the last 20 years. We calculate their average and multiply it by Cisco's current earnings per share to get a fair value of $54 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models, excluding the multiples valuation model estimate as I explained earlier. The intrinsic value we get is $56 per share, which is higher than the current stock price but lower than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $51 per share, which is still higher than the current stock price. So with a 10% margin of safety, the stock would be a buy today. Now, we won't go into details about Cisco's dividend safety, financial statements, risks, and so on, which I could potentially cover in another in-depth stock analysis video if there's interest. But just considering Cisco's limited future growth potential, you might want to consider a higher margin of safety. With a 15% margin of safety, the acceptable buy price is $48 per share. With a 20% margin of safety, the acceptable buy price would be $45 per share, which is lower than the current stock price, but just around its recent 52-week low. It was actually just around that price last week, so I wouldn't be surprised if it trades back to that level in the near future. In terms of Wall Street's expectations for Cisco stock, they're forecasting it to trade at $54.5 per share in 12 months, which is just under our estimated intrinsic value, implying a 15% potential upside for the stock from current levels. So in summary, Cisco does look like an attractive buy today with a decent margin of safety. It is also a company with a very strong balance sheet and limited debt, so definitely worth a deeper look. And remember, undervaluation alone is not a reason for buying a stock. There are several factors to consider, such as the company's financial health, growth potential, competitive position, potential risks, as well as your own risk tolerance. And more importantly, you should always remember to do your own research and fundamental analysis before making any investment decision. With that being said, I really hope you found this analysis beneficial. Let me know your thoughts in the comments below, and if you would like me to make an in-depth stock analysis video for Cisco. If you enjoyed this analysis, don't forget to like and subscribe. Thank you very much for watching. Until next time.